here's what we have. We have Solana, FTM, and Doge, and those do 20, 37, 60%, right? So around 120% more, 120% right here on the altcoins. And then we have, ETH just doing its thing. But you can see how huge that switch is, which the dashboards recognize when there's a highly volatile move. It switches over to the altcoins mostly because those strategies start working, whereas the range trading strategies obviously are not gonna see the light of the day right now, which is as it should be. Because right now we have, since what was the entry here, all of those actually entered around the 28th of February. So since then, we've made 120% on those strategies, which is pretty solid, assuming that we don't do anything, they just trade in the background. And that's something that I want to talk about today, of how anyone can get to this level and the problems that we went through, which, there were plenty of them, and how we overcame them, or at least how we found solutions that worked for us. And that's what we're going to cover today. So anyone that is thinking about working with bots, making their own bots, or thinking about, buying bots or using other people's bots, this is going to be a very, very valuable session for you, because I will tell you right now what are the things to look at when you look at bots, when you look at the performances, and how you can spot bots that look good but are not, and bots that look good, the history is amazing, and then you start trading it and the trading is just horrible. And there's specific reasons why that is the case, and that is something that you see a lot. And the sad part is that many people that are making bots don't even know how to really test them in the first place. So I wouldn't say that it's not their fault, it is, but they're unaware of it. So, who's to blame? So, I'm not saying that our dashboards are perfect, right? But, waking up and seeing a situation like this on our account is always a nice day. So, that's what we're going to cover today. Consistent profits with trading bots, and how to turn unprofitable bots into a hedge fund worthy quant trading setup. Okay, so let's just go into it. So, trading consistently with bots, what does that mean? What it is? Bot trading can be the difference between constantly and painfully losing money in the market and finally finding your hard-earned breakthrough and being consistent, right? So basically, we know the struggles. Every single person here knows the struggle of what it is to trade manually. And, that is probably the main reason why I started coding in the first place, was because I didn't like the alignment between, I knew that the strategy was good, and I've seen that also, in our hedge fund, also talking to other traders. And at some point, it was funny to me almost, where there's a clear strategy to be followed, and that strategy is good. It's been proven. There has been hundreds of thousands of dollars spent to test that strategy, literally, and it's a good strategy. And then there's people trading it, and they lose money. And when they lose money, they're like, oh, yeah, actually, the strategy went this way. I should have done this. I just didn't do it. I just need to do it next time. And the next time they do the same thing. And the next time they do the same thing. And it's simply because of that huge mental and emotional toll that trading takes from you. And that is simply what trading does to people. And if you trade for a long time, then it's going to get better. You will be able to weather the storms more. But even then, whenever you have a sign of weakness or something like that, then you are very likely to be punished by the market. And the very dangerous part is that just being uncautious for 10 minutes can eradicate most of your account. And that is the incredible dangerous downside that you have in trading. And that's why trading works in general, because the chance that a retail trader without any structure or any help is gonna weather all those storms and not blow their account is very, very low. So it takes incredible amounts of discipline to a level of a professional athlete or professional soldier or fighter pilot or something like that. That is the level of focus and attention that you need in order to trade, truly is. And the crazy part is that a bot takes all of the necessity away, right? Because a bot just executes. Like, it is the best soldier you can possibly have because it only executes orders, and it executes it every single time, and also much faster than you can, right? So quantitative trading, which basically just means bot trading, is being used by the best and largest traders and institutions in the world. Compared to a lone retail trader without any quantitative support, they stand no chance. Trading is a zero-sum game, as we know, and you need to at least keep up with the competition to have any chance at all. So why is trading beneficial? Bot trading beneficial? First of all, no emotions attached. We talked about that. No human error. Once a strategy is proven to work, the bot can execute the exact strategy 24/7, right? It doesn't have to sleep, it doesn't have to eat, it doesn't have to go to the toilet, and it can execute it exactly the second, the millisecond the signal comes out, it can execute it, right? A human cannot do that. If you were to stick on your screen for as long as you could, and a signal comes in and you need to execute it quickly, the lag between that is at best 1 second, probably higher. And that's if you're fully focused. Imagine being fully focused 24/7. It doesn't work, right? So the thing is that if institutions and Wall Street and traders, high performing traders, are using bots and are using algorithms in order to help them trade, and trading is a zero-sum game, meaning that it's a direct competition against those people, then you stand absolutely no chance, because you're trading against a bot that has no emotions, that knows exactly what to do, and that is very, very fast. So in order to increase your likelihood of success, at least looking at this and learning about this is absolutely fundamental to your success. A bot can see complex patterns and calculations instantly and act on them, right? When we would talk about the stochastic strategy, right? When we look at trades with the stochastic strategy in a Discord, including me, and we look through 12 time frames, it takes me at least 5 minutes to wrap my head around it. At least 5 minutes, probably like 10 minutes to really get a good bias. A bot can do it in 0.1 seconds if it's slow, right? So it's a huge difference, and just because of the time and era we live in, that is the reality, that this is who we compete against. And there's different bots. There's bots that trade multiple times a second, and then there's bots like our bots that are simply swing trading. So they're just automating the execution of longer term strategies, which are obviously the most consistent. So long story short, algorithms are fundamentally better equipped to trade like humans. Self-explanatory. All right, algorithmic trading at QC. We've developed hundreds of bots and strategies in the past 4 years. Most of you guys know my story. We started coding because we needed to automate strategies, because we couldn't sit there and trade them 24/7, and that just grew and grew, and it was really a snowball effect. We kept coding, we kept developing, and the fact is that in order to get to the first automated strategy that was working, we had to burn through, like hundreds of strategies in order to get there. So the learning curve, especially without any prior knowledge, is obviously pretty large. So that's why I think that for us, because we've learned this, it is our responsibility to share our failures and learnings, because that can literally save you 4 years of your life. So I think that it's only fair if we share those things. We've been trading our bots and algorithms with over $6 million per trade in the market, usually around $30 million in revenue, volume per month. And that was fully automated. So between multiple bots, there's usually around $6 million of volume per trade. So those bots have been tested, they've been tried, and they've been run with larger sums. We've seen the slippage, we've seen the market impact, we've seen all those things. And those are all also very valuable learnings that we went through. We've been managing our portfolio with algorithms for the past years, showing a consistent profit year over year of 500 to 2,000% per year, regardless of market conditions, 500 to 2,700%, depending on the aggressiveness of the bots. Obviously, you can pretty much go as high as possible. You could go even higher than 2,700%. In fact, I developed a hyper aggressive method of trading these strategies, which include a higher level strategy that manages those small strategies with super high leverage, 20x and up. And the point is, it works, but you blow the small separate accounts very frequently. Like, you get liquidations like once a day, but you can reload them with the overall strategy all the time. And really, it's a hyper aggressive growth method. We've been doing that too, or we developed it. Hasn't really been running live because we don't have the necessity for it, and we don't need the additional risk because we have consistent performance over many years. So while the idea of bots is amazing, the reality oftentimes is very different. When you decide to use a bot, either built by you or someone else, you look at the historical data, launch it, and are eagerly waiting for your millions to appear out of thin air. You'll most likely be disappointed. For some reason, even though the bot works in history, it does not work in live trading. Why? There are a few reasons. The next points are learnings that we have gone through and solutions that worked for us to outgrow the obstacles we had and achieve consistent results with algorithms in the market. So here are a few points. Number one, overfitting, which is the most common factor that any bot or strategy that you guys are trading is not going to work. People making bots often rely on historical data to determine if a bot is profitable or not. And that is one of the biggest mistakes they can make. Because your strategy worked in the past does not mean that it will work in the future. In fact, it'll most likely fail because it is overfitted. What is overfitting? Overfitting is adjusting your strategy to perfectly work on a set of historical data, optimizing, so to speak. People call it optimizing, but really it's overfitting, which will break the strategy on any other set of data, even live data. How does overfitting look like? Well, let's just look at this. Is actually a pretty good example here. So let's look at this. Sorry about the alerts. So let's just look at total 3. Let's just assume somehow you're trading total 3 on the monthly time frame. And you look at this time frame and you're like, okay, so I see the stochastic here and I see the price action. And right here, the stochastic just topped out right here. And then the price or the index went up 460%. So now I will make a strategy that will long every single time the stochastic on a total 3 tops out. And this, honestly, this could be actually an okay strategy. You should actually check it out because we can have something very similar here. But let me just go to a different time frame to be honest, because I might have just given you a good strategy that's not overfitted. But similar situation. Let's just say every single time, or let's just say that on the monthly time frame, we learned that and we're like, okay, well, that means that it has to work all the time. So we're going to go here and we're going to overfit it right here. And we're like, okay, so there we topped out and it went further up. Here we top out, it goes further down. So let's just change our strategy and be like, every time we top out on a 12-hour, we'll short. Every time we bottom out, we'll long. And you will find a specific time right here, specific section, and you start optimizing, right? Quote unquote optimizing. So you're like, okay, well, if the stochastic is above, say, 87.8, we will short, but we will not short below that because it didn't work here. So we're only going to do that, and then we're only going to long if the stochastic goes below 5.62, but not at not at 8.5 or something like that. It needs to go exactly here. We're like, okay, well, that would mean that we would have a great long here and a great short here. Great. So now we just overfitted the strategy, because what's going to happen? Well, we're going to go to another data set that we haven't seen before. And what do we see? Okay, we're going to long here, get blown, like the account gets blown out. And we lose the account, and that's it. So then we go, say, somewhere else. Let's see, we're looking for a long. The long doesn't even happen, and we miss this move, right? So it's overfitted. I hope that this explanation kind of makes sense. Really what it means is that based on historical data, we set up rules because it worked in historical data, and then we expect that to work somewhere else, which is not gonna. So that is overfitting. How do we solve it? First of all, your strategy needs to be robust, meaning it needs to be based on a principle so fundamental that it is true in any market at almost any time. For example, our ETH turtle, our Bitcoin bully, those are trend following and trend reversal strategies. The base of that strategy is that when the market starts trending up and the stochastics reload in a trending market, we long. That can be on Ethereum, Bitcoin, Euro USD, S&P, ES, Apple, Tesla, Nvidia, gold. It does not matter. That idea of the market is true all the time. The idea is, in a trending market, when the stochastic turns against us or reloads, basically like a rubber band being extended to the downside, it's going to snap back. That is the theory. It can be the housing market. It does not matter. That's the base of the strategy. So because it is based on an absolute fundamental, it's much more likely to work in any environment, right? We're not overfitting it at all. We're saying that when there's a trending market and a stochastic goes down, the price is more likely to snap back up. That's what we're saying. We're not saying if the stochastic goes to 5.35 below, and then the 4-hour stochastic goes to 3.56, and I don't know, a golden unicorn falls down, then we're gonna long. That's overfitting, right? Being too specific means that you are drowning your strategy, and it has no space to actually work somewhere else. So that's what overfitting is. And first of all, the base of the strategy needs to be on some form of fundamental. You need different data sets for development, testing, and validation of your strategy. You can build it on one data set, but the data sets that verify your strategy cannot be known to the strategy before. What does that mean? What that means is that when you develop a strategy and you do it on Total 3 monthly, like we just did, right? That is just the development stage. To see if it has any relevance, you need to test it on a different data set. You cannot test it on the same data set. You can't build a strategy on one data set and then optimize it till that data set looks good and then expect it to work well anywhere else. That data, the performance, the percentage performance that the first data set, the building data set has zero relevance. It only becomes relevant when other data sets look good as well, because then you actually have a strategy, you don't have an overfitted script. You need different methods of validating, not just backtesting on historical data. For example, looking at volatility of the strategy to see how reliable your performance is in the first place. Monte Carlo simulations, which is a simulation that shuffles your trade order to see if the strategy persists or if the performance was just a coincidence. Hyperparameter testing to see changing to different settings of your indicators and strategy change the performance too much. If they do, it is overfitted. So what that means is that there is other ways than just backtesting to see if a strategy works. One of them is obviously look at different times, look at different markets, look at different time frames. If your strategy allows, you can do Monte Carlo simulations, meaning that you take the backtest, shuffle it together, and see if the performance is still good, or if it just was an accident, which very often happens. And accidents happen very, very often because we, as a human mind, optimize for them because they look good. Hyperparameter testing, meaning that, let's say we have the stochastic strategy, right? Our settings are 1416. So if we would slightly start to change the settings, if we change the setting from 1416 to 1417 and the performance of our strategy is not working at all, then we were overfitted. Because as we slightly change the parameters, the strategy should slightly decrease and not just drop down. If it drops down, we're overfitted. So these are the things that we look at in order to backtest this, truly backtest a strategy and analyze a strategy. And if we're looking at bots or algorithms or strategies that you want to trade, these are the things you need to be looking at, right? These are the things that the people that develop them need to have done, and they still need to look good in these situations. And these are the real metrics to see, okay, is a strategy, is it even possible that a strategy or bot is going to work on the future data, or is it just overfitted on the historical data? Because building a bot that's just overfitted on historical data and looks great on historical data is very, very easy to do. All right, so that was number one, overfitting. Number two, the costs are not implemented. On any exchange that you trade, you have costs attached. You have exchange fees for every transaction, and you have slippage. Exchange fees are a percentage fee that you pay for each transaction on an exchange, right? So that means when you enter a trade and when you exit a trade, you pay it twice. Slippage is the loss that you have when you enter a illiquid market. For example, if I enter RNDR, which we talked about yesterday, a coin that's probably going to do very well. If I just market buy $10 million of RNDR, I'm going to move the market. So my average entry actually is going to be much worse than the first entry that we had, obviously. So if I do that, I'll move the market and have a high slippage. Slippage is felt even in less extreme scenarios, especially if your strategy trades a lot. And this is a big mistake that many people do. At QC, we try to do the least amount of trades as possible for the highest gain possible. Why? Because entering and exiting the market costs you every time. In fact, if you have a scalping strategy that trades 100 times a day, you will lose up to 10 to 30%, depending on your exchange, in loss just in the fees. So not talking about slippage. So you would have to make 10 to 30% a day in profit just to break even, right? So if you trade a lot, if you trade often, very often, then you need to make like 10 to 30% in profit just to break even, just because you paid for all those fees. So that is something very important. The setup, that setup is a fundamental disadvantage, and you're swimming against the current. That's why it's very important to factor in cost and slippage. So the third point, live trading deviates from backtesting. So we've talked about slippage, we talked about overfitting, which is something very, very common that many people do. Now, when you're actually live testing and when you're building a strategy, it's possible that once you start trading live, the conditions you've had in your backtesting don't apply to your live trading. For example, you might have had 30-minute candles on your backtest, and the only price that your backtest had was the data at the close of the 30-minute candle. However, on your live testing or live trading, you let it make decisions every second. So like 1,800 times within a candle, which will obviously give you different results. So that is, let's say I have just a data sheet of 30-minute, of like a 30-minute time frame with candles of historical data, and I run all my back tests on that. And then I'm like, okay, this looks great. I'm live trading, and then I see trades that wouldn't be there on the back test, and I don't know why. Well, because you're using live data and the live price when you're live trading, but you used historical data in 30-minute intervals when you were backtesting, meaning that you were looking at the price only 30 minutes in the backtest, right? Because you don't have the granular data in between. But on live trading, you were looking at the actual ticker data, which is, thousands of data points. So your live trading is not the same as your backtesting, so it's not going to work, obviously. So just the realization of knowing, okay, this is how I backtested. If this works, I need to trade live exactly the same way as I did when backtesting. So you would only be able to make decisions in the market at every 30-minute candle close when you're live trading, for example. Another factor could be that your execution is too slow or calculation is too slow, and you always get worse prices than you initially simulated, or maybe your slippage is larger than you anticipated, or your fees. All these factors will ensure that your performance will not be according to your backtest, and that can then trickle down and snowball into big performance differences. And really what it comes down to is that people use so much time on backtesting and building their strategy, but then when actually live trading it, they never do that, or they don't test it. So then they get shocked that the performance is not the same as the backtesting performance. And the reason that is because your live trading is not the same as the backtesting. You were not looking at the fees, you were not looking at the slippage, and you're probably not even trading the same way as before. So how do we solve it? First of all, any backtest performance that we have, we cut in half. So any performance that we have, we cut it in half right away to account for unexpected factors that we did not factor in. Our strategies and bots needs to be good enough to still be profitable enough to be financially sensible to trade, even at half of the performance. So if your strategy makes 1,000%, you will assume that it will make 500%, best case. You simply just cut out one half of your performance, and it still needs to look good. Secondly, we introduce an alignment period in which we will be live trading and then continue our simulations and backtests at the same time. And what we're looking for is that the same trades and prices are in the simulation and in the live trading. Once we see that, we can say that our backtest has validity and that we can expect predictable results from the strategy. So as we start live trading, we still simulate those trades. We just do a backtest. And obviously, the same trades that are in the backtest needs to be on the live trades. And if they are exactly the same, then we say, okay, we are aligned between our backtesting and our live trading. And if we're aligned between those, then we can say, okay, well, we can expect the results that we had on our backtest into our live trades. So how do we solve this? We understand that, so that is it, the alignment period. And the last point can be that the strategy has a low performance period. Every single strategy has good periods and bad periods. That's just what it is. If someone tells you that a strategy works great all the time, they are lying or they don't know what they're talking about. So every single strategy has good periods and bad periods. That is just the reality of trading. If your performance is bad and you have thoroughly implemented all the points above, it is possible that your strategy is in a low performance period. Turning it off or starting to filter out strategies is not the solution, because it will start to interfere with what made the strategy great in the first place. And this is a mistake that I see so often, which is that a strategy has natural cycles. It will do great, and then it will have times where it does bad, and there's times where it does really bad. And that is just a strategy. That's how the market is dynamic, and we're trying to fit something somehow static onto a market. So there will be periods where it's good, there will be periods where it's bad. That's just a fact. People trying to force the strategy to work well all the time are going to get burnt. So what I see very, very often is that people try to start and filter out the batch trades, or start to not trade during specific times and trade during other times, and really just start overfitting a strategy that was profitable in the first place. But you just start messing with that instead of just letting it run, because at the end of the day, it's going to be profitable. So that is not the solution. Interfering of the strategy, putting in stop losses in a strategy that works well is the easiest way to kill it, because you're completely interfering with its performance. So because you're going to kill trades that would have turned out well, and so on and so forth. So that's not the solution. And what we found is that any time we tried to interfere with trades, the performance would only drop. But we still had to solve the situation when we had a big drawdown, because we couldn't just run a strategy, with $6 million per trade and be okay with an 80% drawdown. Like, that's just not a possibility. So how did we solve it? We understand that each strategy will underperform sometimes. We cannot change that. What we can change, however, is the environment around it. First of all, we need to understand in detail why the strategy works and why it doesn't. And once we do, we can pair it up with another strategy that works in opposite times, which means negatively correlated. We do this by building strategies around opposite market fundamentals, trend following versus trend reversal, we talked about that, or engaging in different markets, Bitcoin versus altcoins. So we have a minimum of 5 strategies trading at the same time, which allows us to find consistency even during the most volatile and unexpected market movements. What does this mean? We take a strategy and we do not interfere with it, but we still analyze, okay, why does it work? Why does it not work? Very, very often it's correlated to the current market environment that we're in. A trend following strategy is going to work well during a volatile market, but it's not going to work that well during a ranging market. Reversal strategy, same thing but opposite. So what do? We bundle those strategies together, and then we average out an average performance of both of those strategies, and then that is our account performance. And we add in more strategies, not just 2, because you have different market environments. You have ranging and trending markets, yeah, but then you have alt seasons, right? So during alt seasons, we want to do something else as well. This is a great example that we have right now, actually, with the bundles, with the strategies that are working, which are altcoins just pushing up, right? Whereas our range trading, our main coins are on the back burner, right? So this is a good example of that. But what that means is just, instead of relying on one strategy and forcing that one strategy to work no matter what, we have multiple strategies that work, and we put them together and have them work together, right? So you have multiple data points, you have multiple performances, and then you have, a management above that we can talk about for weeks. But you want to make sure that you don't expose your portfolio to, you cannot be 100% short, right? So there's a max percentage that you can be short, and stuff like that. But really what it is that we put together multiple strategies that are negatively correlated, and we still get consistent results without having to interfere with the strategies themselves. The strategies themselves are trading freely. But we also have other strategies that are making up for the losses that another strategy does. Right, so how do all these 4 steps look implemented? Everything we talked about today we learned because we have done all the mistakes I have outlined many times over. And it has been a long journey with a lot of failures and learnings, but the result of that journey are strategies and bots that truly perform. Our flagship bots are the QC dashboards, which is an all-in-one system that creates strategies, thoroughly tests them with everything that we talked about before, bundles them together into negatively correlated bundles, which are the dashboards, and then trades them live. All our strategies are based on fundamental market principles, rules in the market that will never change and can be applied to any market we choose. The individual strategies have been tested thousands of times on different data sets, coins, markets, sectors, and timeframes, and have gone through countless simulations to ensure that they are robust and work in any market environment. All simulations and tests have been done with aggressive fees and slippage to account for unexpected costs. On top of that, they have been live trading for years with the exact same numbers that are simulations, slightly better because the costs are aggressive in the simulations, that generated thousands of % in profit. So all those points we have gone through and we have failed at, and we have figured out a solution, might not be the best solution, but a solution that works. And now the strategies that we have are not overfitted, they are aligned, the costs are very aggressive in the backtests, the live trading aligns with the backtesting, and they're negatively correlated bundles, so even during bad times we have good performance. In the past 4 years, where we have made over 3,000% in profit, the max drawdown that the strategy had, our main index had, was 30%. 30% drawdown in a 4-year period. In that 4-year period, Bitcoin dropped by like 80% at least twice. So it eradicated 80% of its worth at least twice. And our maximum drawdown was 30% in that time. And this is the investor bundle, the low volatility bundle. And then obviously with like how aggressive you want to go, it's basically infinite. We do have, like, I did work on a bundle that never made it live for investors because there was no need for it, but a high leverage bundle of 20x per account where we have made like insane returns. Like, I'm not even going to say the numbers because they don't make sense. But it's based on the same dashboards. It's just a different management, right? So when we talk about trade management, when we talk about trades, this is basically what it is, just on a different level. So these dashboards have gone through all the trial and errors, and they're what they are right now. And yeah, they've been doing well. This is the equity curve from 2020 with their numbers. And once again, we talked about the numbers that we need to look at yesterday and today, also at the volatility, at the max running drawdown, at the Sharpe ratio. All of that we covered. Sharpe ratio is very good here. And this is including the fees, including the slippage, including all of those things. These strategies are live in our bundles, which have been selected by hand for the highest negative correlation and best possible consistency in the long run. The result is Sharpe ratio of 2.8. Above 1 is a good Sharpe ratio. In fact, we've just finished a retail auto trading software that our members can use and auto trade the dashboards the same way as we do. Algorithms that have been tried and tested for years with thousands of hours of work and millions of dollars invested in them. Essentially, you can run your own private hedge fund for a fraction of the price. Obviously, if you can put the price on a hedge fund, but I guess it's just a valuation. I don't know. This has been our secret weapon for a long time. And truth be told, we were very secretive about it, but now as we went through the details and found out that more people will not worsen our trading performance, I feel the obligation to share this with the world and give you the chance to trade with the dashboards yourself. If you want to set it up and have the dashboards trade for you and turn you into a profitable crypto trader, then schedule a call with me through the link below, and we can show you how quick and simple the onboarding process is in order to start the dashboards for auto trading. Let me know if this information is helpful, has helped you on your journey. And if you have any questions regarding trading bots, quant trading, I'm here to answer the questions. This PDF I'll send to you guys as well. I will send it out to other places too. The main part here is the understanding on what really makes the performance in any trading market. And bots are, or algorithms or strategies, are a great way of understanding and seeing the bottlenecks and problems that a strategy has or your trading performance has, because those bots will just do what you tell them to. So if something is not clear, the bots will not know what to do. And if something is clear, you will not know what to do, and you will do random things at that time. You just don't realize it. So really what it just comes down to is you're trying to find consistencies and static happenings or static situations in a dynamic market. The better you find those, and the more often you find those, the more money you're going to make. The best way to execute on them, and also the hardest way, by the way, to execute on them physically, is with bots. However, once you manage to do that, the huge added benefit of not being able to sit in front of your laptop all day and just get mentally crazy and then still lose money because you messed something up is very, very big. And just having this and being able to have it run in the background, go to sleep at any time you want, wake up and see, where is it? This is very nice. So, yeah, that's basically everything I wanted to cover. I hope that, I know that it might have gone a little too technical once again, but I hope it was somehow understandable, and that the problems or the mistakes that we have seen with us are things that you don't have to do yourself anymore, and that you can apply the learnings and at least try them out yourself. And, hopefully it will help you on your journey, and hopefully you will get to consistency and profitability quicker thanks to that. So that's basically everything I want to cover today. If you guys have any questions, then let me know. I will be in the Discord all day. We'll have another live call probably the day after tomorrow. And yeah, other than that, I'll see you guys in the Discord.